Hey, welcome back. With silver and gold being some of the best performers this year, the mining companies seem to lag behind. Most of them are traded at 2019 levels, when silver was nearly half of what it is today. But with interest rate cuts on the way, these commodities might still have room to grow, which can be very good for the silver mining companies. A majority of the demand comes from industrial uses like electronics or photovoltaics, but investing also has a significant share. So not depending on China is in itself pretty significant, but on the other hand, the commodity will depend even more on the market. This is somewhat similar to gold, but silver has more uses. There is potential from EVs and solar, which can widen the supply gap, and that can have a very nice effect on the price. But there is a downside to having a big amount of the demand coming from actual uses instead of investing like gold. That means that fear of missing out and speculation and so on wouldn't be able to push the price up too much, because it would lower the demand from the real sources and could lead to a balance in the market. It doesn't mean that it can't go up a lot, but it would affect for how long it would remain high, which is also very important. This means that interest rates will also have an impact. I said this in the gold video too, but simply put, today you can get 4-5% per year from the theoretically risk-free treasuries, while silver or gold pay you nothing. At best you can count on inflation protection. However, when the rates get back to zero and treasuries pay you even less than inflation again, silver and gold become a much more attractive option for banks and funds and so on. They have a majority of the money, so they pretty much make the price. So, despite the price being high, there is potential that once the rates are cut, it can get even higher, and this is probably one of the reasons why commodities went up in the first place. But, same as gold miners, silver companies are in a spot where they are much lower than the previous peak of the commodity, and they benefit even more from rate cuts. And since 2021, we can see a pretty significant supply gap, so it's actually pretty impressive that the price didn't go up sooner. But again, this is about supply and demand in relation to the environment and especially time. Anyway, the longer we see such prices, the better it is for the mining companies. That, combined with lower rates, can be very beneficial for them. Plus, with everything happening in the world, silver, gold, oil may not be such a bad thing to have. Now, let's look into the silver companies. Let's begin with Pan American Silver. After buying the Latin American assets of Yamana Gold a year ago, they became a more diversified miner, producing silver, gold, copper, lead and zinc with operations in the Americas. They see relatively high all-in sustaining costs for silver and gold, but also higher production. If they can produce gold at 1.4 thousand and silver at 18 per ounce in the long term, they should have a very good margin. Now, we don't really know how much they can make after the Yamana deal, but in a very good year they made around 300 million. This for a 7 billion market cap is not terrible, but keep in mind that commodity prices were relatively high a year ago. They need around 300 million in sustaining capex, so they should be able to break even pretty much any time. They have current assets of 1.4 billion, which cover the current liabilities more than twice. And overall the total assets are well above the total liabilities, so they are in great financial shape. So you pay around 7 billion for roughly 4.76 billion in equity, plus the exposure to silver and gold. They see around 40 to 60 million per year in synergies from the Yamana deal, which is where you get the value from as a shareholder. You know, better negotiation power, 60% higher gold production, maybe some common supply chain elements and so on. So dilution offsets the assets that you got, and what you gain is in long-term synergies. They have a very similar dividend policy to Barrick, which is adjusted to the net cash position. So a very good year can fuel pretty good dividends throughout the cycle. The minimum you get is 40 cents and the maximum is 72, representing a yield of 2.1 to 3.8% at the current price. So not very attractive unless you buy it for like half the current price or even less. Overall, an interesting way to get exposure to silver and gold with very good financials. Now, I wanted to include Wheaton, but keep in mind that this is a silver plus gold and a few other precious metals streaming company, not a miner. They provide financing to pretty much all the big mining companies out there in return for the right to buy a piece of the production at a certain price in the future. So they are kind of buying very convenient options and don't have to deal with actually having to mine the commodity. About 36% of the revenue comes from silver, but gold is the number one source of revenue. They see about 40% growth in the attributable gold production in the next half a decade, which can deliver a lot of revenue growth. We can see that they have a very predictable cost and a very attractive margin at the current prices. They have about $500 million in current assets, which is many times more than the total liabilities, so they are extremely healthy. This is common with royalty and streaming companies, but this is among the best I've seen even in that area. The issue with them is the price. They made about $770 million during a very good year and they are already back at that price. For a market cap of around 24 billion, that's a ratio of more than 30, which is already too much. It basically leaves no margin of safety. Think about it, at the current market cap, you basically pay 24 billion for about 7 billion in cash, commodity interest and investments. That 7 billion is making around 5 to 10% in cash flows depending on the commodity cycle, so it's not that great. Sure, it's close to impossible to see them go bankrupt, but what's the upside? The upside and downside are simply not worth the risk. As a result, the dividend is also very small. From this price, they can never pay you 10% for example unless they get a lot of debt. And if the prices fall, you can lose a lot of money. So like the other royalty and streaming companies, this is not a buy for me at the current prices. Now Fresnillo, I think that's how you say it, this is the number one silver producer on the planet. They have a bunch of silver and gold mines with operations in Mexico. With about 600 million in capex, the free cash flow was negative, although a majority of it is in developments, and that's a pretty common issue that I'll talk about later in the video. The all-in sustaining cost was high for every single mine, even when adjusting for developments and everything. It's simply much bigger. Sure, they are okay now, but what if silver and gold drop again? There isn't much of a margin of safety and I really don't like that. They pay a very small dividend, below 1%, with a dividend policy targeting a payout of around a third to half of the profit. And again, that's the issue with these companies. Even in a very good year, they'd probably give you like 3-4%, which is terrible for a commodity company. Maybe if you get them at like half the price it would be okay, but we haven't seen that since 2008. They have 1.5 billion in current assets, which is about 150 million short of covering all the liabilities. So they are in a very good financial shape, as you are about to see with a majority of the silver companies. There is a bit over 4 billion in equity, traded at around 5.4 billion, so not the worst. Overall, other than the financials, this doesn't look so good. I get that they are investing, but that's not enough to justify the performance and the potential. Plus, everything being in Mexico, there is political risk. And 75% of the company is owned by an investing group, so they do whatever they want with it. Now, first Majestic, this is a smaller company with 3 silver plus gold mines and several projects in various stages of development. They are a 50-50 silver and gold producer with pretty ambitious plans. They have a very interesting dividend policy that I have to say I've never seen before. They target to pay around 1% of the revenue per quarter. It's very small now, but when all the projects become operational, it could become quite significant, especially if you buy when the price is low. They aren't profitable due to the high capex, but that's to be expected with so many projects. So this is a bit of a gamble because you buy them for whatever they will be able to produce in the future instead of what they can do now. They talk about the potential of silver thanks to EVs and solar, and again, this is something to keep in mind that you don't see with gold. Even if it's just a 10% increase in demand, it can disrupt the whole supply and demand balance, leading to a potential increase in price. The current assets cover the current liabilities and around half of the total, and the total assets are over 3 times the liabilities, so they are in a very good financial shape. However, they have to fund the project somehow, so they might have to keep issuing debt, or they could even take advantage of a potential increase and issue shares. They are part of the main gold mining ETFs, which can contribute to all of them growing together in case they do. Overall, the ownership is pretty much what you can expect. Maybe a bit too many retail investors, but it's a small company, so it's not necessarily uncommon. They have been in a tax dispute with Mexico since a few years ago, with the state saying that they owe about $500 million in delinquency taxes. That's a lot of money for them, so this is something to pay attention to. So overall there is risk, but also a lot of potential. In this case, I'd prefer to get them below the book value, so maybe around half of the current price. Now another smaller miner, Fortuna. Again, they have silver in the name, but 80% of the revenue comes from gold, and they recently bought a West African gold company for about 60 million. As you can see, it's a bit difficult to get a pure silver play or at least something without a lot of gold. It's about the deposits where you can find the silver, often having both of them together. And even if you get a pure silver company today, how do you know they won't eventually become like Fortuna and the others, which were initially focused on silver? Anyway, they have 5 operating mines in Africa and the Americas, plus what they bought recently, all of them, with the exception of their largest gold mine, having a pretty high all-in sustaining cost. They pretty much tripled the operating cash flow since 2020, and the free cash flow last year was around 60 million. For a 1.4 billion market cap, that's again not very attractive. They expect the production cost to be relatively high this year, but both gold and silver should still be profitable, especially if they keep going up. Financially, they are in a very good position, with the current assets covering the current liabilities and overall around half of the total ones. So they are in good shape and are currently traded at pretty much equity value. But I don't think this is such a good company. Only riskier jurisdictions, high production cost, and keep in mind that this is a majority gold producer and there are much more attractive ones in that industry. My issue is that most of these companies aren't that profitable, even when you take the capex out. If they can't be that profitable, they won't be able to pay some double-digit dividends in good times like iron, lithium, copper, and even gold companies can do. I looked into more companies, not only what you see in the video, and it's usually the same story. You have 5, 10, 15 billion dollar companies traded at like 40 times what they can make in a very good year. I get something like 20 or 25 in anticipation, but 40 is way too much. It simply leaves you no margin of safety. You can still make money, I don't expect the market to be too rational about it, but if you don't, you are overpaying quite a lot for what you get. I probably wouldn't invest in silver companies at these prices, but if they fall enough, some of them can be kind of interesting. Maybe some of the smaller miners are fine at the current prices, but the bigger ones don't seem that attractive. You know, if you look even into the bigger gold companies, there is much more potential at a much better price, not to mention the smaller ones. Let me know if you know a more interesting silver company, but so far I can't say I found one that I would invest in at the current price. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.